Oracle stocks are trading 40% higher today. For a company of this size, nearing a staggering $1 trillion in market capitalization, it is outrageous to see such a move in a single day. This type of price action is not supposed to happen with a company that large, yet here we are. It feels less like rational investing and more like the final burst of euphoria that has marked every speculative bubble in financial history. The so-called tech bubble 2.0 may be approaching its peak. The unbelievable surge. To put this into perspective, Oracle's market value added nearly $400 billion in one session, more than the entire GDP of countries like Ireland or Denmark. Historically, companies of this scale trade in single-digit percentage swings even on extraordinary news. For Oracle to leap 40% suggests the market is no longer pricing based on fundamentals but is instead caught in a wave of fear of missing out, FOMO. This isn't just about Oracle. It reflects a broader market mania where investors have convinced themselves that technology stocks will rise indefinitely. Every dip is bought aggressively, and every headline, no matter how modest, is treated as a reason to push valuations higher. Echoes of the dot-com bubble. We've been here before. In the late 1990s, tech stocks soared as investors dreamed of a future transformed by the internet. Companies with little more than a website and a promise achieved billion-dollar valuations. Eventually, the bubble burst, erasing trillions in paper wealth. Today's market looks eerily similar, only magnified. Instead of scrappy startups, it is giant corporations like Oracle, Microsoft, and Nvidia that are experiencing outsized gains. These companies at least have revenues and profits, but the scale of their rallies defies economic gravity. Price-to-earnings ratios have stretched to extremes. Analysts continue to raise targets after the fact, justifying the unjustifiable. Fuel behind the frenzy. What is driving this mania? Several forces converge. Artificial intelligence hype. AI is the buzzword of the decade, and investors believe it will change everything. Any company remotely tied to AI is rewarded with massive inflows. Oracle's cloud business is now being lumped into the AI trade, even if the actual impact remains uncertain. Cheap money legacy. Years of near-zero interest rates flooded markets with liquidity. Even though rates have risen, the echoes of that easy money remain. Investors are still conditioned to believe central banks will step in if things wobble. Momentum and speculation. With passive funds and algorithmic traders piling into what's hot, upward momentum feeds on itself. Prices go higher because they have already gone higher, regardless of fundamentals. Signs of a peak. A 40% rally in a trillion-dollar stock is not normal. It is the kind of event historians will one day point to as the ultimate sign of excess. Other red flags are flashing. Retail investors flooding social media with victory posts. Analysts scrambling to justify price targets that looked insane only weeks ago. Market commentators saying, "This time is different, because of AI." The truth is, it is never different. Every bubble convinces itself of its uniqueness. Every mania believes it has transcended history. And every single time, the bubble bursts. What comes next? The question is not whether this bubble will end, but when. Markets can stay irrational longer than skeptics expect. The rally could continue for months, perhaps even a year. But gravity cannot be defied forever. At some point, earnings will matter again. At some point, reality will catch up with expectations. When that happens, the reversal could be brutal. If a trillion-dollar stock can rise 40% in a day, it can also fall just as quickly when sentiment shifts. The investors who rush in at the top often suffer the most devastating losses. Conclusion. The market mania continues, and Oracle's shocking surge is the clearest sign yet that we are living in tech bubble 2.0. History tells us how this story ends. Euphoria, disbelief, collapse, and regret. For now, the party rages on, but prudent investors would do well to remember that markets, like life, eventually demand balance. What goes up, especially at this speed, must come down. Right finger if you found this analysis useful. Don't forget to like this video. share it with others, and subscribe to the channel so you don't miss future updates on market trends and financial insights.